I think what the markets were looking at is the cuts that come later. And I think the interpretation, the misinterpretation of the economic data that came out this week was that, oh, the economy is stronger, and so maybe we won't get as many rate cuts. And I think that's what boosted the dollar. That's what weighed on gold. But if you actually understand the economic data, it was all bad. It's all a weak economy with higher inflation. It's stagflation. It's bad economic news. But so many traders just have no understanding of basic economics. And so that's why in the short run, the markets do the opposite maybe of what they should be doing.
Good evening, everyone. In today's economic analysis, we're diving into the latest insights from renowned financial expert Peter Schiff, who predicts that we are on the verge of witnessing the biggest gold breakout in history. Schiff's analysis centers on the recent fluctuations in the gold market and the broader economic conditions that have contributed to these movements. Let's unpack the key points of his commentary. First and foremost, Schiff addresses the recent behavior of the gold market. Gold has been hovering above the significant $2,500 mark, a threshold closely watched by traders due to its psychological importance. This level is often seen as a strong indicator of gold's bullish potential. However, despite this optimism, there has been a noticeable pullback in gold prices recently, with gold closing just above $2,500, a slight decrease of about 0.33% from the previous week. This minor decline in gold prices has had a more pronounced impact on gold stocks, with the GDX index falling nearly 2% and the GDXJ index dropping close to 4%. Schiff highlights the nervous sentiment among traders who have reacted quickly to this slight weakness in gold prices. This behavior reflects a broader confusion among investors, who seem to be misinterpreting economic signals. Schiff argues that many traders are mistakenly viewing signs of economic weakness, such as persistent inflation and stagnation, as indicators of resilience. This misinterpretation has contributed to a stronger dollar and a temporary dip in gold prices. However, Schiff emphasizes that the reality of the situation is quite different. The underlying economic conditions point to a struggling economy with high inflation, a scenario often described as stagflation. Despite the short-term market reactions, Schiff believes that the long-term fundamentals will eventually prevail, leading to a significant market correction.
That very minor decline in the price of gold. Gold stocks got hit pretty hard. The GDX was almost down 2%, and the GDXJ was almost down 4% on a nothing move down. That's how nervous these gold stock traders are. I mean, there's no optimism. I mean, not even close to euphoria. They are very skeptical. And the minute they see the price of gold go down, even slightly, they're like dumping their gold stocks. And the reason that the GDX wasn't down more was because Newmont kept hitting new 52-week highs, because somebody finally upgraded Newmont to a buy. I forget the firm that upgraded it. But I talked earlier this year when Newmont got downgraded to a sell, and I was buying more Newmont. Even though I have a huge position in Newmont, I had to buy that downgrade because I thought it was so ridiculous. So finally, it got upgraded to a buy. But I thought the interesting part about the upgrade was the price target was only about 10% above the current price, which is ridiculous. I mean, why even bother to buy it if you think you only got 10% upside? I mean, they waited for the stock to move up dramatically. I don't know what it is, 60, 80% from the lows to say buy it for the next 10%. I mean, the price target is ridiculously low compared to where I think it's going to go. But I think Newmont getting that upgrade, and it kept hitting new 52-week highs, that's what propped up the GDX. Newmont's not in the GDXJ, which is why it was down closer to 4%. But neither of these indexes should have been down. They should have been up. It doesn't matter that gold prices are down. They're still above 2,500. These gold stocks are priced for gold to be much lower than 2,500 because none of the gold stock investors even believe that gold could get to 2,500. And that's why they think it's not going to stay at 2,500. They're right about that because it's going much higher than 2,500. Also, the dollar index bounced back a little bit on the week, again, based on the misinterpretation of the data that came out during the week. I think the traders looked at this data as meaning, well, maybe the Fed is not going to cut rates as much as we thought.
Investors who understand these broader economic trends and position themselves strategically stand to benefit from the inevitable realignment of market prices with economic realities. Schiff also touches on the recent movements in the U.S. dollar, which saw a slight bounce last week. This uptick was driven by market expectations that the Federal Reserve might not cut interest rates as aggressively as previously anticipated. Despite the bad economic data, which includes weak economic growth and persistent inflation, the market seems to have interpreted the data as a sign of a stronger economy. Schiff strongly disagrees with this interpretation, pointing out that the economic data actually suggests a weak economy with high inflation, a classic case of stagflation. Moreover, Schiff discusses the Federal Reserve's recent inflation gauge, the Personal Consumption Expenditures PCE Price Index, which showed a steady 2.5% increase for the year ending in July.
I mean, it's pretty much baked in the cake. They're going to cut in September of August, but so the September meeting is coming up. And I think there's no way the Fed's not going to cut. But I think what the markets were looking at is the cuts that come later. And I think the interpretation, the misinterpretation of the economic data that came out this week was that, oh, the economy is stronger, and so maybe we won't get as many rate cuts. And I think that's what boosted the dollar. That's what, weighed on gold. But if you actually understand the economic data, it was all bad. It's all a weak economy with higher inflation. It's stagflation. It's bad economic news. But so many traders just have no understanding of basic economics. And so that's why in the short run, the markets do the opposite maybe of what they should be doing. But in the long run, the economic fundamentals are going to be borne out. And the markets are going to do what they should do. And that's going to confound the people who don't understand the economics. The people who do listen have a much better understanding of what's actually going on. And so that we can position our investments to profit from the inevitable.
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
You look at the inflation numbers, because the Fed, apparently the Fed likes these numbers, right? These are the numbers they like more than the CPI, right? This is the core PCE, the year-over-year PCE. That stands for Personal Consumption Expenditure. And the reason the Fed likes this number the best is because it's the least accurate. But it's not just the least accurate in that sometimes it's too high, it's always too low. Like whatever the CPI is, this number is going to be lower. And that's why the Fed likes it, right? Because it makes their job easier, because it makes it easier to pretend that inflation is lower than it actually is. And the reason is because of all the substitution and the hedonics. There's a lot more manipulation that goes into the PCE to artificially lower the number. I mean, you got that in the CPI too. So all the government numbers that purport to measure inflation understate inflation. But the PCE understates it the most. That's why it's the Fed's favorite measure. And so the number was supposed to come out, the month-over-month number was supposed to be up 0.2. And that's, in fact, exactly what it was. It was up 0.2. The year-over-year number was supposed to be up 2.5, and it was up 2.5. So exactly as expected.
While this figure aligns with economists' forecasts, it remains above the Fed's target of 2%, indicating ongoing inflation pressures. Despite this, the Fed appears set to cut interest rates next month, a move that Schiff finds contradictory given their past stance when inflation was below 2%. Schiff explains that the Fed's favorite measure of inflation, the core PCE index, is often criticized for understating inflation due to various factors like substitution and hedonics. Even so, this measure showed a year-over-year increase of 2.6%, which is still above the Fed's target. Schiff argues that this discrepancy between the Fed's inflation target and their likely decision to cut rates highlights the challenges the Fed faces in managing high debt levels and the government's struggle with current interest rates.
Good news, right, was the core PCE, not even month over month, because that rose 0.2, which was in line with the expectation. But the year over year core, which was supposed to go up to 2.7, stayed at 2.6, which is where it was the month before. But if you look at this number at 2.6, this is the Fed's favorite way to measure inflation because it's, the most understated. But even this number is 2.6. 2.6 is not 2. In fact, 2.6 is as far away from 2 on the upside as 1.4 was on the downside. Now, what was the Fed doing when inflation was 1.4? Not that it was even there very long. Well, they had the monetary pedal to the metal, right? They had quantitative easing at 0% interest rates. We were so far away from 2% inflation that we needed QE and 0% interest rates to get the rate to go up to 2%. Well, now we're symmetrically as much above 2% as we were below, and apparently the Fed can cut rates. Why? There is no indication in any of this data that we got this week that inflation is anywhere closer to 2% than it was 3 months ago, 6 months ago, 9 months ago, a year ago, when the Fed said, hey, we can't cut rates. We need more data. We're data dependent. We want proof that inflation is coming down. Well, they have no proof. Yet they're prepared to cut interest rates anyway. Why is the Fed going to cut rates? It's not because inflation is coming down to 2%, because it's not. It's because the economy is too indebted to handle the rates where they are right now.
In conclusion, Schiff warns that the market is currently in a period of confusion, where short-term reactions are not aligning with long-term economic fundamentals. He advises investors to prepare for the inevitable correction, where market prices will eventually reflect the true state of the economy. For those who can anticipate this shift, there is a valuable opportunity to capitalize on the upcoming realignment of the market. That's the latest on the gold market and broader economic trends from Peter Schiff. Stay tuned for more insights and analysis on the global economy and financial markets.